Welcome to the deep dive. Today we are taking a structured look at Central Puerto, ticker CEPU, specifically their Q3 2025 earnings call from back on November 12th.
Yeah, and this call was really less about, the past 3 months and much more about the future. We're diving into a story of, a huge structural change.
A massive pivot, right, in Argentina's regulatory environment.
Exactly. It's a pivot that's redenominating value into hard U.S. dollars, and CEPU is right at the center of it.
And that's our mission today. We want to go beyond the headline financials, which were, let's be honest, they were incredible, and really focus on what management said about this new market framework to understand the long-term implications.
It's one of those rare calls where the quarterly beat is almost secondary. You have to analyze the results, of course, but the market's focus is almost entirely on the forward guidance tied to that new framework.
Okay, so let's start with that quantitative snapshot then, because the numbers were unequivocally robust. We're talking about what looks like a quadruple beat, just huge operational momentum.
That is maybe an understatement. The GAAP EPS came in at 7 U.S. cents per share. That's a staggering 161% jump year over year.
But the surprise on the local level was even bigger.
Oh, way bigger. Revenue was 319.6 billion Argentine pesos, which beat by about 11%. It's good. But the local EPS, beat consensus by over 300%.
300%, so 4 times the expected figure. A 4.1x beat, that's immense. How did the market get that calculation so wrong?
Well, it wasn't just, a bad calculation. It was the speed of change meeting some serious operational leverage. Adjusted EBITDA hit 101.1 million US dollars, which is up 64% just quarter over quarter. And operating income was right there with it, up 74%. And this was really driven by 2 things.
Yeah.
Higher spot prices for electricity, and them successfully passing through fuel costs.
To sustain that kind of margin expansion in such a volatile market, it takes incredible discipline.
So let's dig into those operational drivers. Yep. What specifically let them deliver that jump?
Management pointed to a couple of things. First, the Central Costanera plant. It resumed full operations after some maintenance. That immediately boosted their available capacity. And second, the company really showed it could effectively pass through rising fuel costs, which is critical for protecting margins.
And that kind of success often needs a lot of investment, but CPU has always kept a pretty conservative financial profile. Let's talk about the balance sheet, because that's what supports the whole growth story.
Yeah, financial stability is really their hallmark. Net debt stood at a very manageable $160 million. That gives them a net leverage ratio of only 0.5 times their last 12 months adjusted EBITDA.
That is exceptionally low.
It is, especially for an infrastructure player. And that financial strength also got some external validation, didn't it? It did, yeah. Moody's initiated on them and upgraded their rating to AA. Now, you always have a sovereign risk premium in that jurisdiction, but it's still a clear signal of confidence.
Right. Confidence in their management and their ability to generate predictable cash flow. And sticking with operations, their efficiency was really strong.
The thermal availability was at 88%.
And their combined cycle gas turbines, their CCGTs, had a 96% availability. Super competitive.
And those are so important because they're just far more efficient than the conventional plants.
Efficiency is crucial, yeah. But revenue quality.
Yeah.
That's the real star of the show here. Management was very keen to emphasize this. A full 63% of their total revenue is now denominated in U.S. dollars.
So basically 6 out of every $10 of revenue is currency hedged.
Precisely. And that structural shift away from local currency exposure is the ultimate shield against the inflation and currency risks that, have always defined that market.
Which brings us to the main event, the absolute game changer, Resolution 400. This is the strategic pivot for the entire sector. So can you break down how this new framework actually works?
Okay, so think of the old system as largely government controlled. Prices were regulated, they were fixed, and they often lagged inflation, which just squeezed generator margins. Resolution 400 changes that completely. Its whole objective is market liberalization.
Shifting to a marginal cost system, priced in dollars.
Yes. So new spot revenues now have a clear, predefined margin on top of variable production costs. And crucially, it's all set in dollars. No more waiting on the government for tariff adjustments.
That is a massive improvement in visibility, huge. But the new rule also adds a pretty significant new option for them, right?
This is where the real commercial upside is.
Yeah.
Under Resolution 400, Thermal generators like CEPU can now fill up to 20% of their output directly to large industrial users.
So they can just bypass the regulated system entirely?
For a portion of their capacity, yes.
Yeah.
It lets them enter into customized private power purchase agreements or PPAs. It's a game changer.
Okay, let's get granular on the dollar impact. Management gave specific guidance on this.
They did. They estimated that just the structural pricing change from Resolution 400 alone is expected to increase annual EBITDA by 20 to 25%.
And in hard dollars, that's what, 70, 80 million?
Roughly 70 to 80 million US dollars in, let's call it, guaranteed annual EBITDA uplift.
And that number, that figure, excludes any extra margin they get from selling that 20% to large users, which sounds like just pure upside, but is it? I mean, this is Argentina. How hard will it be to actually contract that 20%?
That is the right question, and that's the main execution risk. The mechanism is there, but getting those PPA contracts signed takes commercial skill, it takes market confidence. It's definitely not guaranteed, but the opportunity is just immense.
And beyond that regulatory pivot, they have a pretty thick pipeline of projects about to come online.
Yeah, two critical projects are nearing their commercial operation date, their CD. You've got the 140 megawatt Brigadier Lpez combined cycle closure, that's for December 2025, and then the 15 megawatt San Carlos solar farm for November 2025.
And the uplift from those.
So once they're fully running, Brigadier Lpez should add about $60 to $65 million in full year EBITDA. And San Carlos will add another, say, 3 to 5 million.
And looking even further out, they're making a strategic move into grid stability with these BES projects. Can you just quickly define what a battery energy storage system is?
Sure. BESS are basically giant batteries. They're essential because as you get more intermittent sources like solar and wind on the grid, you need instant backup and balancing services.
Yeah.
And CEPU secured 2 of these projects, totaling 205 megawatt hours.
Which positions them perfectly to capitalize on that grid intermittency.
Exactly. And the contracts are extremely high quality. We're talking 15-year US dollar-linked high certainty agreements. The CapEx is about 130 to 140 million, with CT targeted for mid-2027.
And they're not just limiting themselves to power generation either.
No, that diversification is key. They bought the 80 megawatt Cafayate solar farm, they have forestry assets, and a stake in the Tres Cruces lithium project. It frames them less like a pure utility and more like a broader energy transition and natural assets platform.
Okay, so here's the paradox we have to address. Massive earnings beat, a structural tailwind guaranteeing 20-25% EBITDA growth, low leverage, contracted growth pipeline, and yet the stock closed flat on the day, down 0.07%. Why the muted reaction?
This is the crucial market reality check. The stock was not waiting for this news. It had already priced it in. I mean, CEPU was up 56% in the month leading up to the call.
56%.
And it gained 85% since late September. It was massively outperforming the Argentine ETF, ARGT. Investors were buying the reform, not the quarter.
So the catalyst was already absorbed.
Yeah.
Which leads us right into this valuation tension we're seeing now.
It creates a fascinating debate. You've got sell-side analysts, like at Citigroup, with these aggressive 1750 price targets. Very optimistic. But then you look at other models, and some flag the stock as significantly overvalued, with a fair value closer to $7.
So the market is struggling with how much sovereign risk to assign to these otherwise very high-quality dollar earnings.
That's it. Investors are past the point of if the structure improves, now they're focused on sustainability and execution.
So what are the key catalysts, the milestones everyone is watching now?
There's a dense map for the next year or so. First, they have to deliver those CODs for Brigadier Lpez and San Carlos. That's table stakes. Second, there's a hydro concession auction coming up, which could trigger an extra dividend. Investors always watch for that.
And the third, which I guess is the biggest variable.
Commercial validation of Resolution 400. We need to see concrete, signed contracts for that 20%. That's what will determine if the stock can break through its current valuation ceiling.
Okay, before we wrap up, it's time for our This Is Not Financial Advice segment, where we look for an outrageous but plausible trade idea.
Right. So this is not financial advice. But if we connect all the dots, we acknowledge the rally, we acknowledge the high valuation, but we also believe the market is still undervaluing the long-term high-quality visibility of these new US dollar cash flows.
So you want to participate in the upside, but you also want to respect that current valuation ceiling.
Exactly. The play here, I think, involves a covered call strategy with a long duration. You go long on the CPU common stock, the ADR, but you couple that with selling some deep out-of-the-money calls.
Okay, for listeners who might be less familiar, can you break down what a covered call means in practice here?
Sure. It means you own the stock and you sell someone the right to buy it from you at a much higher price, the strike price on a future date. For selling that right, you get paid a premium immediately. You give up some of the massive outlier upside, but you lower your cost basis and you generate income.
And what would be the specific setup here?
Well, given the tension, I'd suggest selling a deep out-of-the-money strike. Maybe the $20 strike call with a long expiry, like November 2026. It lets you participate in the upside from that 70 to 80 million in EBITDA and the new BOCO cash flow, but it respects that the market needs to see proof before it pushes the stock way higher.
So what's the final takeaway from this deep dive?
The primary structural takeaway is this. CEPU has officially transitioned. It's no longer a complicated, volatile, emerging market utility. It's now a robust, highly contracted, U.S. dollar-linked infrastructure growth platform, backed by a great balance sheet and a clear, quantified regulatory tailwind.
The conversation has shifted entirely from complex turnaround story to execution risk on a fully priced growth engine.
Absolutely. The focus is no longer on if they can survive the macro context, but how quickly they can commercially monetize that 20% large user market. That commercial success, that's the entire next chapter for CEPU investors to explore.
Fantastic analysis, a really fascinating pivot point. Thank you for guiding us through this. We'll see you next time on The Deep Dive.